Hey everybody, good to be here today. My name is Brent Moores, and it is time for Advanced Option Strategies. We do this each week at this time, and we've been going through this series of different option strategies. Today, we're going to focus on diagonal spreads. You know, you may not love every strategy. I think this is a strategy you're going to like if you haven't done them. It's not a recommendation, of course. There's pros and cons, of course, but it's a pretty flexible strategy. And so check it out here. I'm joined by James Boyd in the chat. Make sure you follow James and myself on X at Brent Moore CS at James Boyd CS. And some familiar names in the chat. Happy to have you here. And if you're watching on a recording, we're happy to have you as well. I did put in the chat playlist for this webcast for past sessions. And if you want to see any, different strategies that we do, I'll post that again there. If you're watching on a recording, the playlist link is in the description of this webcast as well. Now, options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general informational and educational purposes only. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Paper Money software application, that's what we'll be using, the Thinkorswim desktop software, is provided for educational purposes only. And all investing involves risk, including loss of principal. If we set a stop order, there's no guarantee that execution of a stop order is going to be at or near the stop price. Past performance is no guarantee of future results, and although we often look at technical analysis in this webcast, it does not mean, Schwab does not recommend the use of technical analysis as the sole means of investment research. All righty, there we go. Let's head on over to the Thinkorswim desktop software. Here's the SPX, S&P 500. We're up a little bit today, bouncing right off. Kissed that 20-day moving average, right off it. So, I know we had a rough week, I guess, bunch of red candles, but red candles happen. And, you get pullbacks like that and like that and that and that. And this, and, at some point, maybe the whole thing goes just way down. But right now, I don't see any clear evidence that it's going to do anything but what it's been doing here. If I were to look at potential support levels, I'd probably say these highs that we've had here, kind of roughly in that area, is a potential support level. 20-day moving average is a potential support level as well. So those are all things, to consider here on the overall market. If you look at most stocks in the market, and I just kind of scrolled through stocks here, most are bullish right now. Most have been trending up there, okay? Most have been trending up. Now, we're talking about diagonal spreads today. There's put diagonals, there's call diagonals, but here's what they have in common. They're kind of a combination of a vertical spread, and you're taking elements of a vertical spread and elements of a calendar spread, okay? So if you're doing a vertical spread, you have the same expiration dates on your two legs and different strike prices. If you do a calendar spread, you have different expiration dates and you have the same strike prices. So with a diagonal, what we're going to do is we're going to take elements of both. We're going to have different expirations, okay? Different expirations and different strikes, okay? Different strikes. So what does that mean? What are the implications of that? There's two main implications on this. And these are just kind of generalities here. But what it's going to do, what it's going to mean is this. It's going to mean it's going to be a directional trade for the most part. So it's going to take the directionality element of a vertical spread. Of course, calendars can be more directional depending on the strikes, but in general, it's going to take the directional element of the vertical spread, and it's going to take the time decay element of the calendar spread. Now, do verticals have some time decay? Yeah, they can have time decay, but by separating the different expiration dates, you end up with more time decay on that. So those are some generalities here of why you may consider diagonal spreads there. All right? We're looking for directionality and time decay to help us out. So that's the first thing I want to mention. Okay. And I want to go to an example here in just one sec. But before I go to that example, let me just mention a few things on this. Just, I've already kind of mentioned, we're going to do one long leg, one short leg. That's like, same with calendar spreads or verticals in this case. Different strikes, different expiration, okay? We're going to sell one near expiration or nearer expiration, and we're going to buy one longer dated. So in other words, we are selling the one that's going to expire sooner. Now, technically, it would still be a diagonal spread, okay? It would still be a diagonal spread if we reverse these, but we're not going to reverse these. If you reverse these and you sell the longer term one, you're adding in more risk, more complicating factors there on that, because your long one could expire before the short one. And so just realize you don't have to necessarily do it this way, but I'm going to do it how we typically teach this, and that is we're going to sell the near-term expiration. And that is how they're usually done. These are somewhat directional. Now, I said they were directional before, but if you're super, super bullish, you could buy a call. Super bearish, you could buy a put. So that's why I say somewhat, but that's up to you on that. But keep in mind this. The long option is what drives the direction on this. So if you're bullish, you're doing calls. If you're bearish, you're doing puts. Long call, long put. The short option, so the long call is going to be the main driver. The short call brings in a premium, helps offset the cost. It also limits the potential reward as well. So it limits the risk by limiting the cost, but it limits the reward a little bit too. So that's what the short option does there. And then let me just add a couple more here, and then we'll move on. I want to look at the example. They're positive theta trades, and they're positive vega trades, okay? So they benefit as time passes, they tend to benefit. If implied volatilities go up, they tend to benefit. Okay, we'll come back to this list in just a little bit, but for now, let's go and just take a look at an example. And so for both, these can be, I mentioned you can do calls or puts, calls bullish. So if we're looking at a stock that we think is more bullish, now I brought up General Mills here, okay? This basic chart describes a lot of stocks out there right now. Just go through a list. Go through a list of the Dow stocks or the S&P 100 or S&P 500. You're going to see a lot of stocks that are above their 20-day moving average, above their 50-day moving average, higher highs, that kind of stuff. General trend is up, in other words, is what I'm trying to say on this. So let's just go through an example, and we'll kind of talk about some of the example, parts of this here or there. But what I'm going to do is I'm going to go to the trade tab. First of all, we're bullish. Stock's a little shy of 40, and we're bullish. I'm going to go to the trade tab. Now, the first thing I'm going to say is this. When I look at this and I see the expirations, notice there's no weekly options, okay? There's no weekly options. These are just the monthly contracts. That's okay, but it limits the potential strike prices. Very often, and we'll give an example later of one that's shorter term, but I'm going to go with one. I don't have a choice on this, first of all, but your time frame needs to kind of match your forecast. If your forecast is, I'm bullish for a week, but that's all I want to be in the trade, it probably doesn't make sense to do a September 18th September 18th diagonal here on our short strike here. But I'm going to go here and I'm going to do this. That's fine. We're selling the shorter term one. We're going to buy the longer term one. I'm going to do September, October. Could I separate it out? Yeah. If I go to, say, December for the long one, it's going to cost me more because those long options are just going to cost more when you buy more time. That's just kind of how they work. Now, the short-term one is the one creating the time decay. But let's do this. So I'm going to go here, and generally we're going to go for the short contracts. We're going to go out of the money a little bit. For the long contracts, we're going to go in the money a little bit, add or in the money a little bit. Okay, add or in the money a little bit there. Okay, so let's go and let's do that. So I'm going to go to September, and I'm just going to use kind of delta here as a measure. Delta tells us how much the option is going to move in relationship to a $1 move in the stock price, but it's also going to tell me kind of the probability of it expiring in the money. So let's do this. I'm going to go, and normally I'd probably target maybe something more in the 30 to 35 delta range. I don't have that choice here. Okay. So I'm going to go to 48. Typically, I'm not going that far close to the money, but in this case, I don't have a choice. I can go significantly out of the money, but I'm going to start here with this $40 short contract. And so to do so, what I'm going to do is I'm going to sell that. I'm just going to click on the bid price. Okay. I just bring this down. I'm going to go and I'm going to look at my October contracts. And generally for our long contracts, we're going to go in the money a little bit. Well, we'll go about maybe a 60 delta-ish or something. We got a 68. Again, we don't have that many choices here. So I'm going to go to the 37.50 strike on that. All right, so that's that. So how am I going to do that? 37.50 strike. I'm going to click on the ask price. I'm going to control click on the ask price. That brings up a diagonal spread. Now, question. Okay. Question was from Chris. Why choose a diagonal over a vertical? For rolling premium opportunities, any other advantages? Yeah, typically the time decay differential is going to be better on this, okay? So they both benefit, they're both directional, but typically you're going to get more time decay differential. Why is that? Well, think about this. Where's your theta highest? Your theta gets higher as you get closer to expiration. If we sell the one that's closer to expiration, we're selling this one closer to expiration, then the rate of theta, time decay, is going to be higher for this one than it is going to be the other one, okay? So that's one of the reasons why. And rolling opportunities. We'll talk more about rolling later, but let's just start with this initial trade here on this. And let's analyze it. I'm going to right click on it. I'm going to analyze the trade. Here's what it looks like. Let me just go. So there we go. And let me just double check. We're at September. I'm going to go to September. I'm going to go to day after initial expiration. I'm going to set my slice to break even right there. So this is what the trade looks like. Here's the current price of the stock. Oops, no, it's not. Oh, I set my slices to break even. Hold on one sec. Here's the current price of the stock right there, okay? And remember how we described the trade. We described the trade as, this is bullish because it's a call diagonal. Here's the current price. If the stock goes up, you can see it's still profitable. We're looking at the blue line here. It's above our break even. This is our break even. We're above that. So if it goes up, we're in great shape. Wonderful. If it stays kind of in the area it's at, we're in great shape. Okay. If it goes down, we're not going to be in such great shape. If it goes down a little bit, maybe not too bad, but if it goes down a lot, it can be, it could be significant. That's why if we cease to be bullish on the trade, we're going to look to exit the trade here on this. Another couple things I want to point out. Here's our current price. Here's our current strike price. Positive theta, right there, okay? Positive vega. Remember, implied volatilities, if they go up, it would tend to help us. It is a bullish trade. That's why we have that positive delta on that trade. Okay, now, what's our max loss on? Well, the theoretical max loss, remember, you can get assigned and that changes everything or whatever, assigned early, but is going to be our initial debit on that trade. Okay, so $213 there on that. There we go. So let me go back here. We're on the trade tab. I'm going to confirm and send, and then I want to talk about managing this trade a little bit. But let me just send this trade just to get it going here for us. Okay, so I just sent that trade in. We filled in. We now have a diagonal spread on General Mills. Okay, let's talk a little bit about management. First of all, if the trade is working, okay, let's say the trade's going great, that's wonderful. If the trade is working, you can let it run. Time decay should be helping you out on that. And at a certain point, you may decide, I've made most of what I can make, or a lot of what I can make. So we're going to exit at, I don't know, 50% of max gain or something. Waiting for 100% is probably not likely to happen, getting 100%, because one reason is you'd have to hold it all the way to expiration. And remember, if you hold it closer to expiration, your odds of early assignment go up significantly in that case, okay? So exit at 50% max gain. So that's just kind of a general rule. There's other rules we're going to use as well. We're going to exit if it goes against us. Exit if have technical breakdown, okay? This is a bullish trade. If we turn bearish on this, if we start breaking support levels, it's no longer bullish. We're just going to get out and cut our losses. The good news is, if, for example, this trade goes against us, let me just open this up here. Let's say we go down, to whatever, our max loss is way down here, okay? Our max loss is way down here. Hold on one sec, because I think I have two. We sent the trade. I have two contracts in there right now, okay? So here we go. Our max loss is way down here. It's actually a little over $200, so it's actually down there. Let's say it goes well against us, goes down to 37. Are we at our max loss? Probably not, unless we get closer to expiration, okay? So that's why you don't have to be super quick to get out necessarily, but if you do have a technical breakdown, we're going to look to get out, okay? Now, question in the chat, would we consider rolling the short? Absolutely, yes, we will. And I'm going to talk about that in just one second. Let me just get a couple more thoughts on here. We're going to exit near expiration, okay? Often about a week to go to expiration. Now, obviously, if we're doing a diagonal spread where we're starting out with the short leg expiring in, say, a week, we're not going to get out immediately just because we're a week till expiration. In that case, we're going to wait until we get within a couple days of expiration probably. But generally, if we're selling a longer term contract out 20, 30 days or something, about a week till expiration, okay? Now, and let me just finish up here, and we're going to go Um, for money management, we'll say we've mentioned this before on other trades, 1 to 2% of active trading portfolio. Okay, we don't want to risk too much on any one trade. Okay, so there's that. There's our general thoughts on diagonal spreads. Okay, what about rolling? Can I roll? Yes, I can roll. Let's look at this General Mills trade. Can I roll this? I can't roll this because if my short leg, say my short leg's going good, in terms I can't roll it out. There's no intermediate strike price, expiration dates to roll it to because it doesn't have weekly options. If things are going well and I want to perpetuate the trade, very often I can roll it, and I would roll from maybe a September 18th weekly or September 18th option to, I don't know, October 2nd, or I may be off a day or two on that, but option. Those aren't available on this one, but yes, we will look to roll in that case. So you can manage that short leg. Remember, the short leg is giving you time decay on that, which is wonderful. If you've made most of what you can make on the short leg, then that would be a time to consider rolling. Whenever we talk about closing a trade, you can also consider rolling a trade. Because remember this, when you roll a trade, okay, when you roll a trade, what are you doing? You're closing the trade, and then you're entering a new trade, okay? We say roll as if we just change the one trade to the other trade. And technically, we're not doing that. Technically, we're closing out the initial trade and we're entering a new trade. So just be aware of that on there. So we will look to roll if at any point, and this isn't just diagonal spreads, okay? Let's say you're just doing a long call and we're getting kind of near expiration or something like that, and we want to roll it. We're closing out of the first one, we're entering a new one. When would we do that? If it makes sense to enter a new trade at that point. When do you not want to roll? You don't want to roll just because you're losing, you're trying to protect yourself, salvage some trade, okay? If it doesn't make sense to do a new trade of this particular type of trade at this moment, then you don't roll it, okay? Now, we say roll, you can do it all in one order ticket. It doesn't save you on commissions. You may want to do it. I've showed rolling plenty of times in this webcast in the past. And in my Managing Your Options Portfolio webcast, we roll things quite often. But it doesn't save you commissions on that. Okay, so hopefully that helps there. Okay, let me clear that. And by the way, while we're here, let me just mention another thing, okay? When we're rolling, you have another choice, right? We have a choice. We can just exit the whole shebang, right? Just get out of the whole thing. Hey, it's been going well or maybe not going well. We get out. We look for something else elsewhere, okay? Number two, we could roll. We mentioned that. You could do that. Another choice is, let's say we're going like, hey, General Mills is just cooking. I'm going to I don't want to limit myself. I'm going to get out of this short call and I'm just going to leave myself with a long call. Okay? Now, one reason not to do that is just, oh, my long call is doing well, my short call is not doing well. Ask yourself, I apologize for the repetition, but if you're doing that, you're changing this trade from a diagonal spread to a long call. Ask yourself if you would enter a long call at this moment. And if the answer is yes, then consider that. If not, no. Okay, why the tight strikes on this one? Here's the reason for the tight strikes. I didn't have much choice, to be very honest on this. When I went to this one, look, I only have $2.50 increments on this. I was either doing a 40 and I was kind of in between. Normally, as I mentioned, when I'm looking at those short contracts, I'm probably looking somewhere in the 30 to 35 delta range on that. I didn't have anything remotely close on either side on those. That's why on that one, I did that. What about the other side? Okay, what about the long contract? Well, normally I'm saying, hey, we're going maybe in the, 55, 60 range. Well, we didn't really have too much choice on that. I can go to 68, which is what I did, or I can go to the 80 all the way to the 81. You know, ultimately it doesn't matter. That's why, that's the beauty of the Analyze tab. When you pull up the trade on the Analyze tab, you can then tweak things around a little bit and see if does this risk profile look good for you. If the answer is no, you can just say forget the trade, or maybe you tweak it and you could change some strikes here on this if you want. I could change this and make it 4250 and look and see how that looks there. Okay, so that's this. But remember, on these trades, again, not just on diagonal spreads, make sure you know what your break even is. Make sure you know what your max gain is and your max loss. If you know those data, and from the break even, you get a sense for the probability. Now, we already kind of looked at the probability here on this, and we said it was, it was up slightly positive. Oops, I did that wrong. I got to add 11, basically 12 to 47. That's the odds of it being above our break even. Okay, so this is our max gain here. Still good gain here. Good gain here. Does that break even work for your trade? Does this max gain, our reward to risk ratio, work for your trade? If the answer is yes, then maybe you consider it. Okay, let's move forward. As I mentioned, let me just see if there's anything else I wanted to mention on the management thing. I think that's pretty much what I wanted to mention on management. Let's go to maybe a bearish example. Okay. What am I looking? Look, on these, we start with this. We start with the following. We start with the outlook. Bullish or bearish? Bullish, call diagonal. Bearish, put diagonal, if you're going to do a diagonal. For this, we'll look at things like trend, support, resistance. I'm going to call this bearish here on UPS there, okay? We're going to consider things like liquidity. There's other trades out there that you can look at that are bearish. Most of right now are trending up, but so I'm going more bearish on this, but check liquidity out. Okay. Let's go to our trade tab. Now, notice we have weeklies on this, so we have more expiration dates. I don't need to go out as far. I can go out 7 days on this. Okay. And so I got 7 days, and I'm going to sell this. Am I going to sell calls or puts? I'm going to sell puts. Why? Because I'm bearish on this. I'm going to go somewhere in the 30, 35-ish range delta. I've got 36, close enough. We're going to sell that one. I'm going to click on the bid price, okay, of the puts. And I'm going to go out to, we'll go out to September 4th. We'll take a look at this, okay? So here's a 1 week difference on these diagonals. I'm going to go puts again, but I'm going to buy the put. And I'm going to look for my delta up here, and we can go around 60-ish delta. You can spread these out a little wider if you want, a little narrower. Now, if I go wider, what's the consequence if I go to the 104 on this? Okay. What's the consequence if I go to the 104? The consequence is it's going to cost me more. There's the 296 less our credit on the short side. Okay. Uh, let's go to the let's go to the 103, 236 minus the credit. So this is going to be a cheaper spread here. Hold down the control key. You can click on that. And we can certainly tweak this here. Again, fairly narrow. We can make this 104 if we want. It's going to cost a little bit more. Did you see that? Okay. It was a little hard to see. 103, 150, 104, 210. Let's analyze this trade. Okay, here's my trade. This is what it looks like. I'm bearish. This is the bearish pattern that we're looking for on this one there. We can set our slices to break even. Let me go. There's August 29th, set slices, break even. There we go. So we're about 55, 56% break even or better, about 44%. This is if we hold it all the way to expiration. 44% break even or worse on that. Does this pattern make sense for us? Of course, it's still going to be positive theta, positive vega on this. If I look at this, and you can always look at your implied volatilities. Here's my implied volatilities. It's implied volatility. It's an average implied volatility. It's not trending up. I guess ideally I'd like it to be low and trending higher. That maybe be the ideal. As we approach the next expiration is still a couple months away. What we'd expect is implied volatilities to kind of creep up in that point here. Right now, it's low. Can it go lower? Yeah, I mean, this isn't a floor just because it's the bottom of the graph, but it is something where we maybe expect it to creep higher. So that would tend to benefit the trade there. Okay. So let's do this. Okay. Let me just go back to here. Remember, double check your break even, your max gain, your max loss. Max loss, theoretical max loss is going to be 210. Remember, we do risk early assignment on this, and we only have a week till expiration on this. Now, let me hit some questions here. Okay. So to figure out rolling the short side, would you then look at 50% gain to determine the roll? Okay. If you're just looking at the short side, remember when I said, hey, 50, if you get 50%, I was actually referring to the whole thing. A lot of traders would look maybe something closer to the 70 or 80% range on the short side, at which point you can determine whether you just want to close out of the whole thing or roll the short leg. Okay. If you want to roll the short leg, look at the risk profile graph and see, does it make sense for me to continue on this trade? Am I still bullish on this trade? If it does, then you may roll. You got to make sure that the expiration dates make sense. You have, like on General Mills, we didn't even have that choice. But if you're like, I got what I made out of this, I'm thinking it's more neutral-ish right now. You're probably just going to close out of trade. Okay, other comments in the chat. Schwab coaches tend to close out if they. Okay, so Sam says, personally, I go for every nickel, down the fine Lowry. Okay, you can do that. It's not a right or wrong thing, folks, whether you close these out. Let's say you have a short position and it looks like it's going to expire worthless. Can you hold it all the way to expiration? You can. Yeah. James in the chat said law of diminishing returns. Yeah, I mean, you can try and get a little bit more out of it. And most of the time it's probably going to work out for you. But, it's we try to save ourselves from more risk on early assignment and the chance that something turns in from a big winner to a big losers. But you can certainly do it both ways. And I'll tell you what, I don't always close out early on those. Okay, so that's UPS. Let me just enter this. Now let's say we go, I want to get out of this here. Let's look at UPS. And I'm going to say, look, we're kind of getting, we're, it's going down. We got a high, we've got a lower high, we've got a lower high. I, I'm thinking, but if it breaks above, say, we'll say 106, I want to get out. Okay. 106, I want to get out. Well, how do we do that? Okay. Um, Let me go here. And um, how would we put an exit above 106 on this? So what I'm going to do is I'm going to change my advanced order to first trigger sequential order. I'm going to right click on this. I'm going to create an opposite order. I'm going to say, I'm going to make this a market, good till canceled. Click on the gear. It brings up another window. I'll bring it up. It came up on a different monitor for me. This is what it looks like right here, okay? And then I may need to scroll down a little bit depending on the size of your screen. And we said, look, it's blank here. There's nothing there. There's nothing there. If you click on below symbol, just click on it, UPS, okay? It puts an underlying stock. If the underlying stock marks greater than or equal to, we said 106. 106, we're going to get out, okay? Now, does that mean we're going to get out right at if this is at 106? Look, I mean, this could gap up to 110, 120 or something. But that's how we're going to do that trade. Confirm and send. And now we have a stop order, or it's a rules order. Theoretically, it's not a stop, but it's essentially kind of trying to fulfill the same purposes there on that. Okay? So that's how you do that if you want. So that order didn't fill quite yet. Let's see if we can get that to fill. Okay, there we go. We filled on that now. Okay, let me just check on time. Okay, we're getting a little lower on time, but let me go through some pros and cons. So we did a call example. We did a put diagonal example. In future webcasts on my Wednesday webcast, that's managing an options portfolio, we'll look at these in the future and we'll talk about managing these in the future. But let me mention this in terms of maybe some pros and cons. Okay. The pro of these trades is the short contract gives you probably pretty decent time decay. Okay. It does limit the potential gains you get on this. Okay. You can, this is a more complex trade than just a vertical spread. You're spreading things up across different expiration dates. So that complicates things a little bit. The key expiration date is that first expiration date, because you need to make some decision, close, roll, or whatever, modify by that first expiration date, or ideally before that first expiration date. Okay? Now, George brings up a question. He says, if I'm planning to roll a 30 Delta original that's going my way, it's still available. Another 30 did. Okay, all right. So here's what I would say. Let's say you're rolling and things are going, we're still bullish on it. Okay, we're still bullish on it. What do you roll to? Generally, what I would say is roll to something as you would as if it were a new original trade. Okay, whether you're doing calendar spreads and rolling, you may turn it into a diagonal spread, or a diagonal spread and rolling, or a short option, any short option. More often than not, we're rolling to something that's out of the money, because the goal is to get take advantage of the time decay and let it expire out of the money, let it expire worthless. Keep the odds of early assignment down. And so very often we'll look for something in the maybe 30 to 35 delta. Now, you can certainly roll to something, let's say you see something with a 10 delta. You could do the 10 delta, but what's the problem with the 10 delta? The problem with the 10 delta is it's going to bring in very little credit because it's so far out of the money, and the amount of time decay benefit you're getting from it is probably going to be pretty little too, because there's just not that much extrinsic value left on it there. So that's why this is kind of, I'll say a sweet spot. Now, you'll see sometimes we go out of that range. When you're rolling out, whether it's this diagonal spread or maybe it's a short put, okay, that you're rolling and it's gone maybe for you or against you, you're resetting the trade as if it were a new trade. We're going back to that delta. That would be the main consideration I would see on that. So that would be my answer on that one there, okay? Let me go and let me just show, I'm not gonna have time to go through the full trade, but let me just show one more example I was gonna do if I had more time. And that is I was gonna look at Uber. As I mentioned before, you could bring up a lot of stocks out there. And what you're gonna see on a lot of stocks out there is you're gonna see, higher highs, higher lows, and above our 20, above our 50, bullish type trade. And so that's what, so in that case, we're going to look for a call diagonal. I'm going to go to trade. I'm going to go out. And now we have expirations, different expiration dates. I don't need to go, I don't need to go, here, look, we can do this as our short contract. It depends on your time frame. If I'm thinking this is going to, I want to take advantage of maybe a 10-day move on this, where was I? This is probably an appropriate type time frame. If I want to take advantage of a 30-day move, this is too close to expiration. I'm going to double check bid-ask spreads here on this, okay? I'm going to go probably to, I'll go to maybe an 81. That's about a 34 delta on that. I'm going to sell that. And then in choosing your next expiration, just realize if I choose this 21st expiration, there's no possibility of a roll. That's okay, it's not a bad thing, but some traders like to be able to roll. If I choose the 28th expiration, which is probably going to give me more liquid options, by the way, because it's a monthly expiration, that would give me the opportunity to roll the 14-day expiration to the 21 at some point there on that. So you can do that if you want, but it's going to cost you more because if I go longer term on that long dated expiration, on the long contract, the contracts are just going to be more expensive. I'm going to go in the money, at the money, in the money, somewhere maybe 60, 65 delta, and I'm going to hold down my control key, and there is that trade. And again, if I want to put in an exit, I'll probably decide, well, look, I think this is, for example, maybe this is a support level. If we break below here, I'm out of there. I'm going to exit that trade. So we'll say 74, we're out. So I can do that. First trigger sequential, right click, create opposite order, put on my gear. It brings up a different, clicked on the wrong thing, brings up a different window. Okay. And we're going to say if Uber marks less than or equal to 74. Okay. So here's what we did today. Save that. I'm going to send that. Just remember as we're doing these, just a few things to wrap up. Start with the outlook. What's your direction? Plan use your, you can use your deltas to try and help you on short strikes. Generally, short strikes are going to be out of the money. Long strikes are going to be at the money or in the money a little bit. Check the liquidity. Look for event risk, such as earnings coming up. If you want to deal with those, you're going to use limit orders on these typically. Know your exits before you enter, and just position size accordingly to be conservative on your trade. All right, everybody. That was Diagonal Spreads. Make sure you subscribe to the Trader Talks channel. It will help you find not just this webcast in this series, but other webcasts, different instructors as well. James teaches a great Investing Master Series webcast on Tuesdays at 11 o'clock Eastern Time. I teach a Managing Your Options Portfolio on Wednesdays at noon Eastern Time, where we follow up on these type of trades. And hey, everybody, it's Friday. Have a great weekend. Coming up next, we got market and sector analysis. Thanks for the help in the chat, James. And everybody, have a great weekend. Bye-bye.